Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
All right. As people are dialing in, or I shouldn't say connecting, you've already dialed in. People are connecting. I will offer greetings. Mark Yusko from Chapel Hill. I'm joined by Xavier from Points North. And we are going to talk today, and actually Sachin couldn't join us today. He is at a symposium at Harvard Business School for board members. Getting educated. So as PhDs like to do, lots of education. So we are going to talk today about the genius of the Genius Act. And for those that aren't familiar with the Genius Act, the Genius Act is short for the Guaranteed Electronic Negotiable Instruments and Uniform Standards Act. It is the first comprehensive U.S. law specifically focused on governing stablecoins, and really will be a key element or a key cornerstone on all of the digital asset ecosystem. And it goes to this question: can the U.S. truly become the center of the digital world, which has been stated by the president and the crypto czar and everybody else? One of the important things that the Genius Act does is it provides a combination of clarity, legitimacy, and a number of safeguards around the ideas of stablecoins and digital assets. So from the core framework perspective, just to lay the framework for X and I to have conversation, it gives an issuer framework. So basically says who can issue stable coins. And it's interesting because some would argue that this is a little bit of a power grab, because historically anyone really could issue a stable coin because you didn't need permission. But now with this as a law, it will be only federally or state chartered institutions, e.g. banks or trust companies, that meet strict criteria. And we'll get to some differences in that in a little bit. Second is it mandates a one-to-one reserve backing. So no more algorithmic stable coins a la Luna, which, I would say Terra, or Luna came to Terra on that fateful day 4 years ago. And all stablecoins have to be fully backed, meaning one-to-one reserve, by high-quality liquid assets, cash, T-bills, central bank reserve. Very key point that you can use the central bank assets, and we'll talk about that. There are some requirements for audits and public disclosures, which has been a challenge for one of the largest stablecoin issuer, Tether, which we'll talk about, I'm sure. So the second kind of core tenet is federal and state regulatory coordination. So the Office of the Comptroller of the Currency, the OCC, has essentially set up a payments charter. So they're the big boss, or the final boss if you're a gamer. But then there's a bunch of smaller bosses. The state chartered entities can issue stable coins if they comply with federal baseline standards. And this, in theory, avoids a kind of patchwork of conflicting state laws, which, we've seen in other places. The third is this idea of consumer protections, kind of a loose form of FDIC style. So it won't be a federally mandated program like the FDIC, where the banks put in some premiums, and they can basically guarantee about 3% of the bank assets. So if your bank fails, in theory, up to like, I think it's 1.25 million, 5 accounts of 250K, you're insured. Well, yes, so long as less than 3% of all the banks fail at the same time, you're insured, but it gives people peace of mind. So if a stablecoin issuer fails or goes bankrupt, customers do have first rights. They're first in line for the reserve assets. That's kind of similar to how the FDIC works. And it mandates that disclosures be in plain language. Of course, no one reads all the disclosures, but it's supposed to be in plain language. So the fourth tenet is very strict, again, theoretical, restrictions on unlicensed issuers. It will be illegal, strong word, for an entity to issue a U.S. dollar-backed stablecoin in the U.S. without proper registration and compliance. That is specifically targeted at Tether. So this applies to foreign issuers offering stablecoins in the U.S., particularly those via exchanges or apps. It's a little bit of an overreach in a decentralized world, but that's their prerogative. The fifth tenet is it clarifies digital asset tax treatment, although not really. So I love the way they do this. They say, well, we're clarifying it, except what the clarification really is it calls on the IRS and the Treasury to propose clear tax treatment for personal stablecoin transaction, wallet-based microtransaction, and gas fees and blockchain rewards. Again, big potential overreach. I think very little is going to come of this particular tenet because it's a proposal. It's kind of like when they said, "Oh, we've approved the Bitcoin Treasury." Well, no, you approved a study led by the crypto czar of a Bitcoin Treasury for the government. We still don't have it. And then the sixth, and this is, a little nebulous, but encouraging blockchain innovation. So that's noble. And they call it sandbox provisions, allowing for innovation pilots in DeFi, cross-border payments, as long as you subject yourself to regulatory supervision. Again, I think most people are not going to do that. And agencies must support responsible financial innovation and interoperability, and that goes to the whole SEC. So, what does this all mean? One, it's good that we have legal clarity of sorts. So now we know that banks and asset managers can deal in crypto. We have some relatively clear regulatory guardrails, which should lead to greater institutional confidence and adoption and ultimately growth. Second, we have a definition of infrastructure for real world assets, things like tokenized treasuries, cash, and now people can use these financing techniques backed by law. If a stablecoin transaction failed, did you have any recourse? You still don't have absolute recourse, but you have now law, which means we'll have court cases and, class action and all kinds of stuff. This really focuses on scaling USDC and PYUSD. Now, shocking to no one, PayPal is getting plunged right in the middle of this. So USDC, US stablecoin, is run by Circle. It's the second largest and is a clear boon for Circle, and we'll talk about that here in a bit. But why does PayPal get to be involved? Well, PayPal's always involved. Remember who the original two people at PayPal were: Peter Thiel and Elon Musk. Go back and look at that original picture of Elon, who is unrecognizable before the hair implants, and Peter Thiel, who isn't aging, so is clearly a vampire. And those guys are now involved in everything. And PayPal, even though they're gone from PayPal, PayPal gets to be involved. And there's specific language against, and actually there's a ban of algorithmic or under-collateralized coins, which should boost confidence in the good coins. Paves the way for retail adoption. So, retail consumers will be able to use stablecoins for peer-to-peer payments, remittances, e-commerce checkout, online investing. A big thing of the Genius Act is it de-risks the exchange and custodian business. So Coinbase went up a lot, new all-time high, because of this. And Anchorage also gets a boost. Kraken, it's a little less clear. Canadian company, can they get a U.S. regulatory exemption? We'll see. It also clarifies obligations for wallet providers, custodians, and broker-dealers involved in stablecoins. Now, again, the naysayers would say there's some overreach here in that, wallets don't have to be KYC, AML, and all that good stuff. Well, this is kind of trying to make that. So at the end of the day, what does the Genius Act do? It really is a significant turning point. It anchors stable coins in law. So, the House passed it, the Senate passed it, the president signed it July 17th, July 18th. So we actually have law. It should unlock mainstream adoption and does lay the foundation for digital dollars or digital stable coins to be used in global finance, which if everything has to be under a U.S. regulatory regime in order to be used in the U.S., and the U.S. is a big part of global trade, theoretically that helps the U.S. become the center of the digital world. Now, the question is whether this will matter because Tether actually is the largest stablecoin in the world, and it's used by lots of people not in the U.S., and now it'll probably be banned in the U.S. So that leads to some interesting questions. So let me stop there. See if there was one question. How does Genius Act impact MC Digital portfolio? Okay, we'll talk about that here in a second. But X, any kind of opening thoughts?
Yeah, Mark, great for summarizing that. And also, thanks for everybody to join in on this. We've been chatting about this for some time because I think this really marks a really seminal shift in the overall sentimentality about what is crypto's place in the financial marketplace, both the U.S. and abroad. So what we have seen is really this trend towards favorability, obviously, towards an inclusion and of the haves and the have-nots, who will be shepherded into this next phase and who may be excluded. So automatically, Mark, it is, in my mind, putting a showdown, just as you kind of laid out, between Circle and Tether, kind of the two main ones. But really, their market sizes are quite different from one another, right? Like, so you've got Tether as being clear in a way, the 800-pound gorilla in the room, and Circle up until recently, I'm saying post IPO, was relatively small. Certainly in the global context, not see Circle really appear very much outside of the U.S. in any sort of dominant transaction format. So what we're seeing now is this bill almost seems to be in full orchestration with Circle in mind. So even if you kind of run down in terms of the ways that it could be evaluated, Circle versus Tether, there needs to be a compliance aspect, right? So Circle's fully aligned with Genius, right? It's got the monthly audits, the one-to-one reserves, and also when you look at something like the institutional access, that was all part of the IPO, right? So they're eligible for banks and also, DeFi use. But, somebody like a Tether, their reserve transparency, and I think that's probably the point, Mark, where it leaves a lot of conversation. You were there over in Vegas, and so you saw, Tether give the conversation when it was in the Bitcoin conversation, or in the Bitcoin seminar rather. They made a really big point to just talk about how big of an asset pool they have really between just straight up gold bullion as well as fiat cash. But given the size of the stablecoin, Mark, in Tether, I don't see how it's possible that they can get anywhere close to being regulatory compliant in the U.S. at least. So maybe this is also U.S. seeding that market from an international standpoint. However, this is also about U.S. dollar hegemony, right? So crypto always has this kind of underlying question mark. What does this do to the future of the U.S. dollar? But stablecoin is a great way to strengthen both, the digital ecosystem, but then also give the U.S. dollar a boost because, most stablecoins, not all, are ultimately getting denominated in some sort of USD level exchange. You do have stablecoins in euro and some other currencies, but they are far less popular and far less used. So on the one hand, you're saying, the dollar wins here in the digital asset ecosystem, but so long as it complies with this U.S. regulation, when by far and away, out of the 27 trillion transactions of stablecoins last year, most of those were outside of the U.S. context. So this will be a step in the right direction. But if the U.S. truly wants to repatriate, I think there's going to have to be some horse trading, Mark, between what Tether, where they are, and where Circle is.
Yeah, no, really, really important points. I mean, look, can the U.S. truly become the center of the digital world? The answer is no. I mean, I hate to say it that bluntly, but the answer is no, right? 80+% of transactions are outside the U.S. That's going to continue. It's a global world. And, it's a little narcissistic, I guess, if a country can be narcissistic, or maybe the leader of the country is narcissistic, to think that we can suddenly make everybody, play by our rules. So I'm not sure that goal is even a legit goal, but X's point is right on. Probably the biggest winner in this act is the U.S. Treasury and the Federal Reserve, one of which we probably need to abolish. But look, the reality is the U.S. dollar has been in this interesting transition. So, we talked about this from 1776 to 1913, a dollar was worth a dollar. There was no such thing as inflation. There was no money creation except at the local bank level. There was no central bank. And then 1913, they created the central bank, the Federal Reserve, which is neither federal nor has any reserves. And we've been in a one-way decline in terms of the value of that fiat asset. Now, there were two events that stemmed the flow of that decline and increased the hegemony of the dollar. One was 1944, post-war, where Bretton Woods, there's a big meeting, and the leaders agreed that the dollar would become the hegemonic world reserve currency. Now, there have been a lot of world reserve currencies in the history of the world. There's, the Portuguese, and then the Spanish, and then the Dutch, and then the French, and then the UK, and now the US. And it wasn't that long ago, right? Only 110 years ago that, the pound sterling was the world reserve currency. It was the most powerful currency in the world, and the dollar was kind of an afterthought. From 1944 to 1971, the dollar was important, but really wasn't the hegemonic, absolute, center of the universe as it has become since 1971. 1971, the U.S. cut a deal with Saudi to make the petrodollar system run on U.S. dollar backing. And that was critically important because bottom line is that, the the U.S. is only about 8% of global trade, but oil transactions are a monster part of global transactions, and therefore they had to be priced in U.S. dollars. And anyone that threatened that, whether it was Gaddafi or Saddam Hussein, was summarily dismissed, so to speak. And so the dollar has been in this decline. Inflation has been rampant. And I saw a great analogy in the last couple of days that if you think about what money is, it's like a battery, right? Money is what you or I do to store the energy that we create that we want to use later, right? We charge up the battery, we do work, we either do physical labor or mental labor, or we exchange goods and services, but our exchange of effort or energy converted into value then gets stored in money. Well, the problem with fiat money is a government can just print more of it with no effort, and therefore devaluing, or so your battery is constantly draining. You know, it's kind of like we've all had this experience, right? You throw your laptop in your bag and you don't turn it on over a long weekend, and you open it up and the battery's drained. Well, why is that? Well, there's stuff going on in the background and the battery's drained. Same thing with money, right? If you put your money in the bank and you don't use it, you wake up, you know, a year later and it's worth less in a fiat system. So Bitcoin came along and reversed that. It basically recharges itself. In fact, it's, you know, I've been playing this game Monster Hunter lately, and there is a functionality in the game where if you wear a certain piece of armor, every time you get hit by the monster, the armor recharges itself so you can get hit again. Really kind of the same process with Bitcoin, is it recharges that store of value for you. Well, all of this is around this idea that, well, if the dollar was starting to move into other places, like the Chinese were exchanging their debt for gold, or people were exchanging their cash for stable coins or for Bitcoin, and the world was starting to move into this good battery as opposed to this bad battery. Well, what this Genius Act does is it basically makes stablecoins, at least in the US, not outside the US, but at least in the US, it mandates that stablecoins be a home for this debt that nobody really wants, right? The Chinese are selling it, the Japanese are selling it. Now, the people in the UK keep on it, but it's not really the people in the UK. It's shell companies formed in the UK, a lot of them US. But the bottom line is now there's a focus on pushing US dollar-backed assets into stablecoins. It provides, you know, regulatory visibility into, you know, where these assets are going to be. So it kind of reduces the role of the shadow banking system that was out of control of the Fed. So the biggest winner clearly is the Treasury and the Fed, because they get to prolong their hegemonic rule for at least a little while longer. Now, that said, the second biggest winner is Circle, for all the reasons that, you know, they are the fair-haired boy / girl that you know the government loves because they, you know, put everything in U.S. assets, and they are willing to be regulated. They've already got their money transmitter license. Now, they're not going to be forced like Goldman Sachs or Morgan Stanley to become a full-on bank, but they will have to apply for what's called a new stablecoin issuer payment license, basically an OCC charter. And they'll capture a lot of flows. PayPal also, and they have partnered with Paxos, good Notre Dame guy. So happy about that. And so Paxos and PayPal will play a close second. The biggest loser to all of this is Tether. So Tether is clearly in the cross. Now, this is interesting because, you know, the Secretary of Commerce Howard Lutnick bought 5% of Tether through Cantor right before he became Secretary of Treasury. And Tether has become the 7th largest owner of U.S. Treasuries in the world. So even though they're clearly in the crosshairs of not being a regulated, because they're in the Bahamas and all this good stuff. So any offshore exchange, Binance, KuCoin, OKX, they're losers. Any algorithmic stablecoin like UST or Frax, they're out. Unlicensed wallets. This is interesting. So this is a big power grab into the world of wallets. Now, I don't think it will be successful, and I think people will say, F you, I'll just go around the regulatory, or maybe I just want to offer my product in the U.S. I think that's what's going to happen to a lot of these. So unlike, or very much like, I shouldn't say unlike, very much like the history of most legislation, my guess is there were some big contributions made to certain senators and congressmen to make sure that this was favorable to certain companies. But at the end of the day, you're going to see a lot of things develop around this. But I guess my own opinion, and then I'll ask X for his to share his. My opinion is it's noble goal, but the U.S. hegemony to a global, borderless, nation-stateless future, I think it's unlikely. I think we're headed toward a more truly global, digital, on-chain reality that's very different than the, offline hegemonic world our ancestors grew up in.
It's a great point, Mark. And I think also you might add one of the big losers here is any momentum whatsoever about CBDCs or central bank currencies, digital currencies, because that isn't really needed given Genius and Clarity, right? Because that's effectively what USD becomes by U.S.-controlled companies like Circle, and or if financial institutions like J.P. Morgan's of the world now have the tools in place to onboard more stable coins that will increase, the dollar power. So a lot of questions are coming in about kind of like the economic impact here. And what's been interesting, Mark, is that on the one hand, what was probably the largest thing that was really standing in the way of growth in our industry for a long time was sort of the lack of regulatory clarity, which is kind of, I always find ironic, Mark, and everybody on the line, because one of the things that was really touted as the strength of digital assets was the fact that they're unregulated and they can kind of be free to grow as they're intended as protocols and technology. But they kind of reached a point where that was okay for the early adopters, but then to kind of cross the chasm, they needed, like all technology, to have regulation. So as we've seen, both growth from stablecoin, but then also just on the crypto industry in general. So, in the weeks leading up to the passage of this bill, in the weeks leading up to Crypto Week, we saw Bitcoin itself, really explode. And this was kind of relatively quick, right? There were some points where it was kind of sitting close to the halving price, creeping down, 80s. And then when there was a little bit more daylight about what was next on the agenda, we started approaching 100K. And when it was a foregone conclusion that we were going to be in the affirmative and getting some favorability towards our industry and even stablecoins, we went almost in the blink of an eye from 100 to a new all-time high in 123, and we've been resting around, somewhere in the teens, 100, 118, 117. And, what this will mean for our industry is, $4 trillion is, crypto asset value as of mid-July. And we're also seeing now for the first time some better growth in the altcoins. So previously it was kind of different because growth in crypto meant growth to Bitcoin and kind of at the expense of everything else. But that's not been the case with the passage of these bills because more than half of all stablecoins are originated on Ethereum. And I would jokingly say that the other half ultimately resolve somewhere back to Ethereum with EVM compatible chains, or basically, let's say if you have a stablecoin on Solana, it has cross-chain compatibility back to Ethereum so that you can ultimately work with greater number of applications and users, right? So we saw huge gains on Ethereum, and it in that period outperformed Bitcoin. Now it was starting from a much worse position and has not, eclipsed its all-time high. It's still quite far from it, but this was an immediate reaction to the fact that this is going to be a big winner here just because of how strong this platform is. It also saw a rise in treasury company strategies. Those are public companies that all they do is continue to buy digital assets on their balance sheet with the hope that they'll get a market multiple or an MNAV based on their ability to draw upon leverage and or other equity fund investors as they continue to raise more money. So we're seeing increased institutional flow, and really what that means for the portfolio, which is the question that kind of came through, is a lot of positive, right? Because on the one hand, you have growth within the underlying crypto, which we own, but then you also see growth from the equity side or the investments into startups, and we've invested in a couple of these. What's interesting with the way that these companies will succeed is it's very much in reminiscent to Emark of like an FX play, right? So you're going to have local winners and local losers that will kind of battle for the share to onboard the next wave of the digital economy, because banks are, have never been capable of creating in-house technology that really creates a market share unless they have an act of Congress. Well, now they kind of do, but that act is really pushed for the startups in the space, like a Circle of the world, to kind of help onboard others into the new wave. So when you see this international play, we've invested in stablecoin companies in the U.S. as well as in Latin America. And I'll just kind of pick on one, Alfred, that has been really seeing a huge boom. They have been invested by Circle, and in Latin America, like many other emerging markets, Tether dominates. So something like Circle has the hope that they will increase investments in these companies that can do business locally, where they may be otherwise restricted due to relationships with other banking partners. And so when we kind of explore the portfolio, where are we headed? We're continuing to track these local onboarders in the Middle East. It's another opportunity for us to continue this kind of investment. And we've identified already some companies, or we hope that they're the leaders, in places like Africa and the Middle East, which if you follow the fintech growth curve, they have kind of skipped brick and mortar banks altogether and have gone straight mobile and now crypto. So I think that you have two potential gains here. One for the altcoins. Bitcoin will continue to do well as kind of the crypto reserve currency mark, but then also these local onboarders that will really capture a share from banks trying to go digital.
Yeah, no, so many important points. And Circle went from an $8 billion IPO, which people thought was kind of a crazy number, to, today, $50 billion company, got as high as 60 billion. So you say, well, I missed it. And the answer is, in the short run, absolutely. Circle doesn't make that much money today. So I do think, and maybe they get bought before then, but maybe by JP Morgan or Goldman Sachs, because they came out of Goldman Sachs. But so there will be an opportunity to own Circle for the long term at some point. Right this moment, maybe not. Coinbase, on the other hand, I think Coinbase is, I wouldn't call it cheap, but I wouldn't call it wildly overvalued like Circle. Secondary shares in something like Kraken, which is still a private company, that could be an interesting plan. I mean, there are a lot of early investors in Kraken who are trying to sell on these secondary exchanges. So that's something. And then there'll be other stablecoin related businesses in other jurisdictions, like X was talking about. All around the world, there are, examples of companies that are focusing on stablecoin payments in other areas. All of this is really good news for Ethereum. Ethereum, I won't say it was left for dead a few months ago, but Bitcoin had doubled off the bottom, and Solana was up a lot, and Ethereum was kind of dead money, having fallen from 4,000 all the way down to 1,500. And the Bitcoin dominance, which is Bitcoin divided by Ethereum, reached its highest level, maybe the second highest level in history. And people were like, look, and we even asked the question on one of the webinars, like if ETH were created today, would anybody use it? Meaning, if you can use Solana or Avalanche or one of the other SUI, they're faster and cheaper. Why would you use Ethereum? Well, then Ethereum did an upgrade, and the reality is Ethereum was first, and therefore it has a bigger installed base. But the thing that people aren't really paying attention to is Peter Thiel's involved. So Peter Thiel Fellow, was the founder of Ethereum. He's got his hands all over this, so it's not shocking that Thiel's involved in PayPal and that. So all of that says Ethereum is probably, we have a manager that we have capital with who thinks, Ethereum's going to 10,000. No, I think that's maybe not tomorrow, but I do think Ethereum is on its way to becoming the world computer. Now, that's very different than the monetary store of value, digital gold, that Bitcoin is, but a world decentralized computer could be a really valuable thing. So, and if it's going to be the transaction rails for most stable coins, and that doesn't mean there won't be stable coins on Solana or Avalanche or other things, but I think owning Ethereum for the long term is probably, it's had a big run here recently, so might be a little overbought, but I do think that's another play. What else can an individual investor do? Well, you can just own a little bit of everything, right? You could own, Ethereum treasury companies, just like the Bitcoin treasury companies. And you have the added advantage with the Ethereum treasury companies of like famous people and influential people getting involved. So Joe Lubin, who was the Ethereum Foundation, Consensus, not Ethereum Foundation, Consensus, one of the early Ethereum devotees and one of the largest owners, he got behind this, I think it's called Sharp something gaming, and SharpLink Gaming, something like that. And they've, done what, they want to be the MicroStrategy of Ethereum. So that's an interesting construct. There's another one that, again, is run hard, but probably is interesting long-term, called Bitminer. They were a Bitcoin mining company that kind of saw the light and flipped. Got Tom Lee involved. Tom went from being a Bitcoin maxi to now he's an ETH head, and he's been on CNBC literally like every week talking about how great Ethereum is and how Bitminer's buying it, and that company has done really, really well in the public markets. And I think, Ethereum related companies and Solana related companies, we've talked about Upexi on those shows. I think all of those are ways for individual investors to take advantage of, the rising tide does indeed raise all boats in this space. We are moving to a world, it's not going to happen tomorrow, but it's going to happen over decades. We are moving to a fully digital world, right? I say all the time that, my granddaughter, who's about to turn 3 will never have a leather wallet. She'll never know what paper money is. She'll only spend digitally. She'll live digitally. And that's pretty amazing. And so I think there are lots of ways to play this. How does the Genius Act impact our, MC portfolio companies or Gemini Figure? Clearly the success of the Circle IPO probably means that the Gemini IPO and the Figure IPO, which are, upcoming sometime, in this next 6 to 9 months. I don't have any insight on timing there because they're in their quiet period, but we have a number of stablecoin related businesses in, both Fund 3 and Fund 4. We have a payments company in Fund 2, Strike, Jack Mahler's, and he's his 21 Capital with Lutnick. So there's lots of intersections. Generally, everything included in the Genius Act is positive for ABCD, right? It's positive for AI and decision-making tools. It's positive for blockchain as a new de facto standard. It's positive for chips and processors and computing platforms and the global, world computer that is EVM. And then things like encryption on top of that, like FHE, and then data, right? All of this is about data. The real world asset companies that we have in the funds that are looking to tokenize real world assets, they'll get a little tailwind here. So, generally speaking, it's good. Specifically speaking, like Gemini Figure, it'll certainly help them in the short run. So, Ethe and IBIT. So yeah, I mean, look, the ETFs are one-to-one plays with arguably better custody, institutional grade custody, and very little chance of losing your keys and, or getting wrench attacked. So they're not no risk, but they're one-to-one, and what I mean by that is you're going to do as well in IBIT or Ethe as you would owning Bitcoin or Ethereum, because they're going to move one-to-one. If you own one of the treasury companies, particularly one of the treasury companies that uses convertible bonds or preferred stock to get leverage, then you get more than one-to-one, and you get this concept called MNAV, or the premium to the NAV. And those have been, winning trades, and there's going to be more of them. So, yeah, so that's what I'd say about that. X, anything else on any of the specific questions?
Yeah, I think that the idea about, some of the, when I look at the, ETFs, or if I think about investments in companies, ultimately what they're trying to approximate, my view, Mark, is how does one kind of capture this market, right? And what kind of underlying risk am I taking relative to, let's say, if the riskiest thing may be missing the market entirely and just holding T-bills, kind of where do I step in from that? And I think probably the interesting stats to kind of build on what you were saying is that we kind of think that the ETF wrapper is kind of like the financial tool du jour to enter into the crypto space, but that has shifted pretty dramatically in the last couple of weeks even. Over the last couple of months, though, dating back, there has been this accumulation pattern of corporate entities just buying up Bitcoin and Ethereum for that matter, but mostly Bitcoin head start from treasury companies because that was the bearer asset, and then of course others will follow and have followed. But for the third month in a row, corporate entities have outpaced any other instrument in terms of buying Bitcoin, inclusive of the ETH or IBIT kind of holding ETFs. So that's an interesting trend to continue to evaluate. And what does it mean for like individual companies like exchanges? Mark mentioned a couple. Even somebody like a Gemini. Well, these are companies that stand to win, right? Because they kind of took a regulatory based in the U.S. They are, eyeing their own exit opportunities in a moment now where we shifted from when are these companies going to exit to are they going to exit in this cycle, which is a very different kind of question. And I think now we have a broader point to consider. Is Bitcoin and or Ethereum reached a point of no longer being cyclical? And that's the question that people are starting to ask as we move across the S-curve. Now, what does that mean? We know that our industry has historically operated on 4-year cycles based on the halving or the minting of new Bitcoin rewards every 4 years. And so what that's meant is a higher peak and a higher trough along those same timelines, like 2012, 2016, 2020, 24, and if we extended 2028. So we are in a upward pattern, have been for a while. So if you look at your history as Mark and I and Sachin do, that might mean a repricing event for the end of this year or next year. And, we think about that, but also companies think about that. So that means, the question of how do you make money on this? If I'm a startup founder, I'm taking my opportunities now when the regulatory winds are at my back as tailwinds, when Bitcoin is at an all-time high and other altcoins have begun to rally a little bit with, Solana bottoming in this past cycle to $100. Now it's, approaching 200 into 1500. Now it's approaching 3,700. And all the other kind of major coins have begun to really follow suit. So I think it's more about how do I think about my risk of staying on the sidelines, which you're guaranteed to lose relative to what's happening in the market where there are opportunities for accumulation, and really thinking about how to enter from that point of view on your instrument.
Yeah, I mean, look, it's really quite extraordinary, when you think about kind of what happened in the last month since this bill was passed. So, Bitcoin only up 12% in a month, still pretty good month. And, it's interesting. It's always up in July, which is interesting. And, but Ethereum is up 52% in, 4 weeks. I mean, just a crazy move. You look at something like, Binance, which really shouldn't be involved here, but to X's point, everybody is got increased awareness. So, Binance BNB is up 21%, Solana up almost 30% on this. Heck, even I hate this, but Dogecoin went up 44% for no good reason other than supply and demand. But you've got companies like Cardano, which I've said this over and over, and people hate it, but I've yet to meet a developer. And we've met with hundreds, probably coming up on quad digits, 1,000 companies in the 8+ years we've been doing this, and I've never met one pitching on Cardano. Yet Cardano's up 40% because Charles Hoskinson and Brad Garlinghouse, and Brad's from XRP, and XRP's up 47%. So why did they go up so much? Well, the word crypto is used in the Genius Act as opposed to Bitcoin, so it's broader. And there are those that believe that they'd make the U.S.-based stablecoin or not stablecoins, U.S.-based coins tax-free. So is that hype? Is that real? I don't know. Chainlink up 38%. So there are a lot of coins and a lot of projects that suddenly people are like, yeah, this is real. I mean, if we're going to have stable coins running on ETH, and we're going to have stable coins running on Solana, we're going to have stable coins running on Sui, well, what if I want to swap across chain? Well, then I need this concept of bridges like Chainlink. So that is going to be really interesting. So lots going on here. The term payment stablecoin means a digital asset that is or is designated to be used as means of payment or settlement, the issuer of which is obligated to convert, redeem, or repurchase for a fixed amount of monetary value, not including a digital asset denominated in a fixed amount of monetary value. And, little two, represents that such issuer will maintain or create the reasonable expectation that it will maintain a stable value relative to the value of a fixed amount of monetary value. Lawyers got paid a lot to write that definition. Can you comment on the reasonable expectation in the definition? So, look, absolutely, the words reasonable expectation are legalese. There's no way without mandatory on-chain guaranteed audits that you can be 100% certain that there is dollar for dollar backup. And so what the legislation is trying to do, and this is very much, and the second part of the question, is this Tether related? This is absolutely targeted to truncate the Tether advantage and move toward, compliant issuers like USDC and PayPal that will allow the long arm of the law that, AML, anti-money laundering, stuff to go on. Now, there are still people who are going to say, no, I'm going to continue to use USDT and I don't really care if the US doesn't like it. Now, the question is, will people try to ban these things? It's hard, right? I mean, China found out the hard way. They banned Bitcoin and their citizens still owned it and transaction kept happening. So it's challenging, but and then the last part of the question is, does this invite fraud? So I like that part of the question. So by saying that, we made our best efforts or reasonable efforts to make sure there was one-to-one backing, does that mean that the fraudsters could come in? Sure, absolutely. But they're probably already there. So, there's lots of finger pointing at Tether that it's all a big fraud and it's all a big house of cards and that it's all tied into SBF and U.S. regulators and Maxine Waters and all that kind of stuff. I don't think so. I don't think she's a rocket scientist and did any designs. So it's a rambling answer to does it invite fraud? So sure. Like in any market, a couple winners will emerge. I wonder if stablecoin issuers will tier by their reputational. Great point. So look, we've talked about this for a while that, the big four banks, JP Morgan, Citigroup, Goldman Sachs, Morgan Stanley, you could throw Wells Fargo in there as number 5, clearly have a reputational tiering and people like them better than Deutsche Bank, although Deutsche Bank is kicking the crud out of JP Morgan this year and last year and the year before. But it just got so cheap. But there's definitely a tiering, and we said for a while that was happening, right? It was happening in the lenders, the Bitcoin lenders and the stablecoin. Like you could convert fiat into stablecoin and earn interest when interest was 0 in the U.S. That was pretty interesting. And there was a chance that those big four lenders were going to become the new big four banks. Well, they crushed them, that was the then they fight you phase. So now, does this say that Coinbase, Circle, and 2 others become the reputational top tier of the future of finance? Yeah, I think it does. I absolutely think it does. And Bruce's point is well taken in that does JP Morgan continue their reign of terror, so to speak, right? They started it all in 1913, the backing of the Fed and the bailing out of the system in 1907. So, wrote a long piece of work on that. Can they keep control in this new era? Well, only if they buy these other guys. So they would have to buy Coinbase or Circle, in my estimation, because I just don't. I think, it's my personal opinion, X weigh in here. I think digital natives have an inherent distrust of the banks. And you saw the story today, right? The woman, the lawyer for the truckers in Canada, was debanked by RBC. And the New York Times published an article 2 weeks ago saying that a bank account is not a right. I'm like, really? That's interesting. So all of that is challenging. And so I just think there's so much distrust of those big banking institutions that there's no way they emerge at the top of the pecking order. I don't know. What do you say, X?
Totally agree, Mark. I mean, if we saw with Operation Choke Point, it's like they're already created this precedent to where there needs to be an alternative to the traditional banking system that was kind of done by not really being reliant on one main mechanism or any one main exchange or point to be able to navigate seamlessly between the fiat-driven world and the digital assets-driven world. So I think what this will mean, and kind of bringing it back full circle, pun intended, is Circle now under the Genius Act does and is expected to have compliance with debanking or removing stablecoins from what are deemed to be non-active participants or those that kind of are in violation of some of the terms. And so I love the question that Bruce poses as he does in so many of our discussions, because they really provide a lot of thought. And it really reminds me of this showdown that used to exist with the algorithmic stablecoin and the asset-backed one. It wasn't too long ago where you would see yield on stablecoins exceed 10%. So that meant if I had, a crypto asset and got, yield of 10%, that discouraged me from ever holding fiat or ever thinking about a treasury. Well, now that's gone away. And that has been pushed to the platforms like Coinbase. But, the prediction is that too will quickly go away, just as it, did previously with Celsius and Voyager and all the other platforms that were kind of promising this more riskless way to get interest, when in reality it was really based on lending. And that's contracting. Again, my thought is, to push up U.S. Treasuries, which is what it's all about. But we'll
awesome. So, all right. So we will end on that. Thank you for all the great questions. Fantastic conversation. And we'll be back in a month in the dog days of August to maybe continue this conversation a little bit and talk some more about the emerging trends in the digital asset ecosystem. We are grateful for your support. We wish you the best for these last few weeks of summer. Hope your family travels are good, and we'll talk to you again soon.
Thanks, everybody. Thanks, Mark.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.